Hi, this is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investments. Just this past weekend, we saw that the top lieutenants at Ray Dalio's Bridgewater, one of the largest hedge funds in the world, effectively calling the Federal Reserve impotent, saying that they are powerless to deal with the above-average inflation that we are seeing right now. And this has broad, huge repercussions, I would say, huge secondary effects for asset classes around the world. Let's dive right in to understand what sort of this all means. So first, here's my disclaimer, so read it on your own time. And so here it is, Financial Times article talking about how the co-chief investment officer, I think it's Bob Prince, saying, look, central banks could find themselves powerless as rising energy prices rock markets. Effectively saying, look, inflation is here to stay, and the Federal Reserve really can't do much about it without wrecking the economy. And I've done a couple of videos sort of calling out these risks of inflation and these are arguably in a global energy crisis that we're starting to see, partly with China, where they had some rolling power outages and how they had to deal with that. So you can check out that video. And look, China is not alone. Europe is also seeing, natural gas shortages and sky high prices. This is a global problem, a global crisis. I did a video with Nelson, who has a large bet on energy, a large bet on oil, that effectively saying, yeah, this is definitely playing out. This is baked in where you could see sky high prices. And you're seeing it in India as well, like one country after another announcing problems, talking about how they are on the brink of an energy crisis as coal reserves hit critical lows. Just literally, they talk, the head of their electrical authority saying the coal reserves at over half the country's power plants could burn out in 3 days or less as a post-pandemic surge in manufacturing spiked demand for power. So this gets back to that thesis that, yeah, there's this rebound in demand following sort of that slowdown in COVID, and our supplies really haven't caught up to it. So this is, catching a lot of utilities, flat-footed, where they're just not able to deal with it. They're not expecting it. You're seeing entire countries go dark, such as Lebanon, which went without power for 24 hours until effectively the army intervened. As if this wasn't enough, as if a global energy crisis wasn't enough, you're also seeing, I'd argue, a global supply shock that's going on with logistics challenges. I did a whole separate video on that, effectively saying how COVID and challenges with, labor is creating problems where just not enough goods are getting shipped around in a timely way, and it's resulting in huge port congestion. You have freight driver shortages as well. And ultimately, it comes down to this. So, this was from a key slide from Ray Dalio's video on how the economic machine works. I'd highly recommend you check it out just because it's so thoughtful. And he effectively talks about, well, wait a second, what's inflation? And he says, look, you have spending divided by the quantity of goods. So you have spending and you have quantity of goods. And that could be stocks, that could be physical goods, what have you. That drives price. And as you drive more money, drive more spending, and keep the same quantity of goods, you're going to see a higher price. And that's, you sort of saw that with liftoff in stock prices this past year, which is, you see this huge amount of stimulus, huge amount of Federal Reserve stepping in and trying to drive hey, this is the Federal Reserve's response to COVID. Let's do this radical policy of $120 billion month in quantitative easing. Yeah, that's a lot of new credit, a lot of new capital coming into the markets, relatively same supply of stocks. So yes, stock prices go way up. But this is really important to understand for where we are now, because you still have all this cash coming into the system, but the quantity of physical goods is going down. So when you see this go up and this go down, prices could go through the roof. And let's talk about why this is really important for stocks and to sort of understand sort of the broader repercussions here, which is that the problem at the end of the day, the Federal Reserve normally tries to solve financial crises. Think back to the great financial crisis. This was a financial crisis where you didn't have enough cash to go around. You have Lehman Brothers and major banks where it's like, oh yeah, we made this big bet and now we don't have enough cash to sort of plug in our balance sheet because we have this big hole in it because this big bet on, subprime didn't work out. And now that's a zero and we have this hole in our balance sheet. We need cash. And so in that case, having a Federal Reserve step in and say, oh yeah, we'll flood the system with cash, that works. But when the problem is that you have a shortage of goods, the Federal Reserve waving their magic wand of quantitative easing, that doesn't help the problem. And that's the key aspect here. That is why the top dogs at Bridgewater, Ray Dalio, effectively leaning into sort of saying, yeah, this is the reason why the Federal Reserve is in a box. This is why they're powerless, because that magic wand quantitative easing. Oh, you want to do 30 billion this month, 120 billion, pick a figure, a bazooka, whatever. That doesn't work if fundamentally you need something else. In this case, you need more physical goods. You need more energy around the world. You need more production. You need to solve logistics challenges. And the Federal Reserve waving their magic wand in greater and greater, quantities, that actually just makes the problem worse and worse, because you need to address the bottom half. You need to address the denominator. And so that's really what I'd argue is the key challenge here, as we're looking at this. And so it sort of raised the question of like, okay, so what's the Federal Reserve do from here? And I think you have a couple of different choices, that they ultimately consider. And one of which is to effectively say, hey, like, we just have to sit with inflation. This is going to be above average inflation. This is largely the role that I think a lot of folks expect and anticipate, because you look at how indebted the U.S. government is, as well as governments around the world. And it's like, you need to inflate your way out of this problem where the debt that was issued effectively becomes worth less over time. And the challenge with this route of going the route of inflation to solve your problems is, one, it eats your returns. And so, if you're a retiree, if you're an endowment that has, a large bond allocation, if you have a large amount of, fixed income or cash, your returns are net getting eaten significantly with higher and higher inflation. And the reason why that's such a problem is because it really does start creating social unrest, where you start saying, well, wait a second, I was making this amount, and now to be able to go buy my food, it costs more. And you see that around the world generally as inflation ticks up, you do get more and more unrest. And so then this becomes sort of like a political football issue, where when does the Federal Reserve say enough's enough, and how much do they stop it? And also the challenge with seeing potentially higher rates is, you're going to see higher inflation. So what do you expect is going to happen? The bond market's not going to want to, say, hey, if inflation's expected to keep going higher, why are we going to expect a 2% interest rate? They're not going to be comfortable with that. So then you start seeing higher rates, and that also sort of slows down the economy, and that definitely hurts stock prices. So that's definitely something to consider. So the first path that the Federal Reserve can consider is sort of letting it run hot, letting inflation just sort of stay hot, maybe 5, 6, 7% for a while the system sort of works out these shortages in energy and supply logistics. That has its own problems, such as social unrest. I mean, there's the misery index, which tracks unemployment plus inflation. That's the metrics. And it's like, this is a big deal when you start running high. The next aspect, what's the second choice that the Federal Reserve can do? They can try to, so the first one's ignore it effectively and sort of say, this sort of solves our debt problems. The second choice is to try to kill inflation. And the reason why the Federal Reserve is powerless to do this, at least in the words of Bob Prince from Ray Dalio's Bridgewater, one of the top dogs, co-chief investment officer, I believe, at Ray Dalio at Bridgewater, is the reason why they're powerless to do this, and they really won't want to do this to kill inflation, is because it really means, we can't solve that bottom part. We can't solve the denominator. We can't solve these shortages. But hey, maybe we could kill demand. That's really what the Federal Reserve can do. If we just start jacking up interest rates, then you're going to have a problem and you're going to kill demand. And that's one way to beat inflation. Now, the problem with that is, once again, asset prices get completely smoked. So the first scenario, you let inflation run hot, potentially asset prices start going under pressure because rates start moving higher, because investors start saying, wait a second, inflation's not going the right direction and I'm still not being compensated for it. Screw this, I don't want to own bonds. And more investors start bailing out of their bonds. That's the first scenario. The second scenario is Federal Reserve says, we're not going to tolerate this. We're jacking up rates somehow, or we're saying, we're completely cutting quantitative easing. We are quantitative tightening. That's definitely not good for risk on. That is risk off. Asset prices get a huge haircut in that scenario. So those are sort of the challenges that investors, are sort of facing right now. And so then the question is, what should you consider doing? If you want to follow my personal journey, go to unrivaledinvesting.com, click join the journey. And that's where I'm sharing, on a weekly basis, what I'm thinking, what I'm buying, what I'm selling, that sort of stuff. by the end of the month, each month, I call it a potential multi-bagger. And so that's, if you want to follow exactly whatever I'm doing, but that way, if you want to see it. That said, in this video, I am going to talk about there are some steps that you can consider broadly in terms of dealing with what I'd argue is this Kobayashi Maru that the Federal Reserve is facing, where, they're powerless. You're looking at this above average inflation. You're looking at shortages in energy, supply logistics challenges. And so you either let it run hot for longer than people are comfortable with, increasing social unrest, increasing the risk that rates start going higher, or you jack rates higher and kill demand, kill the economy, or hurt the economy significantly by raising interest rates. I don't really view that second one as palatable given how indebted the economy is, because then it would really slow down demand significantly. And so I think, how do you survive in this type of environment? Ray Dalio has repeatedly said cash is trash, and I think because of this very scenario. So I think that's something to be mindful of. That said, maybe it's worthwhile to have some cash to be opportunistic if all asset prices sort of experience a risk off. And that is a possibility. So what I'm personally considering, and these are the different choices I think you could broadly consider. One is to buy commodities. I personally don't like that approach. You can buy commodity companies. I just don't like buying commodities at the end of the day. I like to try to find unrivaled businesses, because over a multi-decade perspective, unrivaled companies are the ones that are going to grow and crush it over time. That said, over shorter periods, years, maybe 5-10 years, you can have periods where you get stagflation or lots of inflation, and it's sort of, that's a period where commodities really shine, and you're starting to see that a bit with some commodity companies doing really well. So I could understand that perspective, and I could even call out a couple of commodity plays that are arguably cheap, but I'm just not comfortable doing it. I'm not comfortable pulling that trigger. But I could understand other folks doing it. I did that video with Nelson, and he's all in on commodity companies, and I'm sure he's crushing it right now. The other aspect is to buy necessities. So, for example, last month I called out a potential multi-bagger, which is a healthcare company trading at less than 10 times free cash flow. And my view is healthcare, that's not going anywhere. No matter what inflation occurs, you're effectively going to say, yeah, we're going to have to raise prices over time because this is a necessary service. This isn't going anywhere. So I'd argue buy cheap necessities. Things that are priced really cheaply, significant free cash flow, and this business is not going anywhere, regardless of what the Federal Reserve does. If they say, hey, let the economy run hot with inflation, this company will be fine. If the Federal Reserve says, hey, we got to raise rates and hit the economy, this company, because it's a necessity, because it's tied to healthcare, should be fine. So that's one approach. But I am sort of talking about regardless, company that's able to deal with inflation. That's what we're looking for here. So then it really comes down to, does this company have pricing power? And I'd say that's sort of the third bucket of things to look at, is can you find companies that you believe have pricing power? Regular viewers know that I call out Alibaba as a stock. In full disclosure, I own it, where that's an example of a platform in China that does have pricing power, where over time, if there's inflation, they're a net beneficiary of it. So look for maybe platforms that benefit from inflation and try to pay a fair price. I'd argue the fourth way to consider doing this is to consider hedges, where you could, say, hey, you know what, I'm going to make a bet effectively against the market, maybe against bonds, and say, hey, as long as, if interest rates start going up, these bonds will get hit. Maybe these, high growth oriented stocks that are really unprofitable, they'll get hit. And so those are, I'd argue, the different types of solutions you could potentially consider in this environment as you're looking at an arguably powerless Federal Reserve. So if this video has been helpful for you, talking about how the top lieutenants at Ray Dalio's Bridgewater is calling out the real risks that I think you're facing with the equity markets. If this has been helpful for you, please make a point of hitting that subscribe button, hit that thumbs up button. And just to be clear, if you don't fully grasp what I'm saying, what I'm arguing here is that the two scenarios that the Federal Reserve is considering, one of which is letting inflation run hot, and the second of which is killing demand, neither of which is good for asset prices, neither of which is good for stock prices. It's arguably risk off if you start seeing rates start to move higher, because folks start saying, wait a second, this inflation looks like it's here to stay and no one's addressing it. I don't want to accept a 2% bond from the U.S. And let's say U.S. global borrowers, global lenders to the U.S. start saying, well, screw this. This doesn't make any sense. This is a terrible risk reward. Let's just plow it into oil or something like that. And so that's odd. Or maybe it becomes a cryptocurrency play. And you saw Bitcoin rally significantly recently. So that's, I'd argue, is the economic layout. I hope this video has been helpful for you. Thanks so much for watching.